Welcome back to Acceptance Finance and Disc 2 in our series called Focus on Finance. Today we're going to have a look at borrowing entities and what might be the right one for you. But first, welcome back, and we hope you enjoyed Disc 1. Might be a good time to review it now, because if you review it, each time a new one comes out, it's going to sink in more. In this release, we're going to look at some typical borrowing entities. While we're not going to cover all of them, we will cover the relevance of the most common ones that are used. We'll have a look at pre-approvals, some how, where, whys and whats. We'll also look at some first homeowner grants and first home buyers, whether they are buying or whether as an investor you may wish to sell to them. Whichever the case, you need to have an understanding of what a first home buyer might go through and what the first homeowner grant entails. But first, what is an entity? By definition, an entity is an organisation, body or person that has a legal identity. A borrowing entity is a name in which the loan is taken out in. A purchasing entity is the name in which the property is purchased. When purchasing property, there can be several different scenarios. While we won't cover all of the scenarios, we will look at the three most relevant and most often used for property purchases. The first being personal purchases. Now this might be one name or multiple names. We'll also look at company purchases, whether it be a holding company or a trading company. And we will look at purchasing under a trust scenario with a corporate trustee, be that a unit trust or a family trust. First, let's cover personal purchases, which are the most common type in Australia. Now, as I said before, there might be one name or multiple names on the purchase. However, in most cases, to be on the application for finance, you need to have a financial interest in the property. You may not be on the title of the property, but to be on the loan, you need to have a financial interest. Now, this can clearly be shown in the instance where a husband and wife might buy a property. The wife may not be on the title. Let's take it that the wife is a company director. And for asset protection purposes, to protect their home, should the company that she's involved with have any form of litigation, she doesn't want to be on the title to that property. So the husband goes on the title, but the husband and wife go on the loan application. To most lenders, this is quite acceptable because a clear financial interest to the wife can be shown by way of the relationship. When I explain this to people, quite often they'll say, but why can't I get a relative or my parents to guarantee the loan? Well, simply because there's no real financial interest for the relatives or parents to be a guarantor on that loan. Even though the kids might leave home and their parents see that as a financial benefit, in legal terms it doesn't show any clear financial benefit. There is, however, an exception when it comes to parents and their children with some lenders. You may have heard of a family pledge loan. This is where a parent might pledge a certain percentage or all of their property value as a guarantee of extra security for that loan. They cannot guarantee on an income basis, but they may put up some extra security. That may enable also the loan to value ratio that we've spoken before to be lowered to a level of 80% or below and avoid the need for mortgage insurance. Let's also look at the case when you're purchasing a property for tax benefit and you may only want one person on the title or one person on the loan or vice versa or any way round. It might be a case where you only want one person on the title, but you still have to have two on the loan for qualification purpose, but the person on the title is the one that can claim any tax benefit for that property in a negative gearing situation. Conversely, take the other aspect, where again, we'll say the wife's the high income earner, but they want to put the property in the name of the husband because he earns a lot less. and the property is positively geared and earning an income. So in that instance, they put it in the husband's name so that any income derived from the property will be added to his taxable income and not hers. So in a situation where the property is negatively geared, it might be placed in the name of the highest income earner so that they can take the benefits of any tax deductions available. If the property is positively geared and earning an income, it may be placed in the name of the lower income earner, so any income derived from it attracts a lesser rate of tax. So that the applicant claims the income or the deduction based on their current earnings. A guarantor can be used for servicing the loan. So back to if you're on title, but you're on the loan application as well, and you have your wife or your husband or your spouse as a guarantor on the loan, this can be used for servicing purposes. You need to take careful note here though, that any guarantor is equally liable for repayment of that loan. And if the loan is not repaid, not only will they come after the applicant and the person on title, but they will come after the person that guarantees that loan. While owner-occupied is the most common type of purchase in Australia, the entity that is used most commonly is also personal names. It's often also used for investment, however, simply because it is the most simple way to borrow. While a property is mortgaged, the lender holds the title until the debt is repaid in full. If that property is sold, the debt must be repaid. Once all costs are deducted and the loan is repaid, the balance then goes to the seller or owner of that property. Now, as stated, investments can be purchased in your name, but we would strongly advise here that you seek tax advice for your personal situation before committing to any borrowing entity. Now we're going to look at company purchases. Now essentially, when it comes to property, there's two types of company purchase. There is a holding company and there is a trading company. First, we'll look at what's a trading company. And basically, a trading company is any company that derives an income through business activities. Now, a number of lenders will be willing to lend based on the income and profit of that company. But they will generally also ask for a director's guarantee, being that anyone that is a director of that company guarantees the loan. Should the loan come into default, again, those guarantors of the loan will be liable for that debt and will be pursued if any debt needs to be recovered. The profit or loss from any investment bought in a trading company's name will be added or deducted from any company trading figures and cannot, in the case of negative gearing, be offset against personal incomes. Holding companies are simply an entity created to hold an asset. A holding company does not trade or carry out any business activities. More on that shortly. Now we'll go to trusts. Trusts, and we're going to talk about the two most common types here. There is more, but we're going to talk about the two most common types, which are unit trusts and family trust. Now I want to put that down. Unit and family. Because I want to keep them in your mind. A unit trust is derived of a number of units. Now let's say we have 100 units in a trust. Now all trusts must have beneficiaries. There must be beneficiaries to the trust, whether it be a unit trust or a family trust. But in the case of a unit trust that has 100 units, those units may be allocated in differing amounts. Let's say you have 4 beneficiaries. One holds 40 units, 2 holds 40 units, 3 holds 10 units, and 4 holds 10 units. If that's the case, any income derived through that trust will be distributed exactly that way, with 80% of the income going to unit holders 1 and 2, 40% equals 80%, and 20% of the income going to the remaining 2 unit holders who hold 10 units each, or an overall 20%. Either way, all of the income will be distributed. A family trust, on the other hand, is what is known as a discretionary trust. Let's say you have the same 4 beneficiaries. The main difference between a unit trust and a family trust is the way the money is distributed. Under a unit trust, as we've said, it has to be distributed accounting each unit holder's percentage or number of units. Under a family trust, it is at the discretion of the trustee as to how that income is distributed. Now, in a situation of property investing with a trust, if you have one person that earns a very low income and one person that earns a very high income, the obvious way would be to distribute the bulk of that income to the person paying the lowest tax rate. But as I said, all of the income must be distributed at the end of each financial year. A trust cannot carry over profit. It cannot hold property. And this is why we have a holding company typically as trustee for the trust. So a typical structure might be a holding company, let's call it Wally World Proprietary Limited, as trustee for the Fox Family Trust. So let's take that. We take a step back to a holding company. And remember, a holding company simply holds the asset. It doesn't trade. So we have a holding company called Wally World. Proprietary Limited, of course, that acts as, and you'll see these letters, as trustee for the Fox Family Trust. Now, remembering that a trust has beneficiaries, the beneficiaries might be mum, dad, son, daughter. So what happens is the holding company holds the property. Now, the holding company will have directors. Now, there can be one director or there can be multiple. But let's say the directors are mum and dad. So the holding company, of which mum and dad are directors, Wally World, acts as trustee for the Fox Family Trust. And the beneficiaries are mum and dad and son and daughter. Now, under that discretionary trust structure, the directors of the holding company decide how the income is distributed. So mum and dad, the directors, decide how Wally World and the Fox Family Trust distribute that income. Under a unit trust, there is no discretion, as I said. It is by the units. But every trust must have a beneficiary. Funds must be distributed either by the units or at the direction of the trustee in a family trust or discretionary trust situation. Please, before doing this, get tax advice on the distribution. Again, if possible and if obvious, especially in a discretionary trust, distribute the income where you can, and where you can be to the lowest income earner so as to minimise any tax that might be payable on that income. A unit trust, just covering a little bit more in it, why it can vary in the number of units is because people might invest a different amount into the property. They might invest different money. They might invest different knowledge. So when that trust is set up, it will be decided at the beginning how many units each beneficiary holds and the income distributed accordingly. Now, the potential advantages of a trust are that it can protect and isolate any investment from your personal assets, such as your family home, because it is held by a company as trustee for the trust. There may be a taxation benefit in certain circumstances. And the biggest one all is you can distribute any profit. There are some disadvantages though. The cost of setup, future accounting costs, a reduction of lenders that may be willing to lend to trusts, and in the instance where a property is theoretically or otherwise negatively geared, you can't offset any loss against personal income. So you have to really ask yourself, if a property is negatively geared and losing income, should you be putting it in a trust situation? Should you be purchasing that property under a trust situation? We've often heard people say buying under a trust can help you increase your borrowing in the future. It can, based on a few conditions. Firstly, it really needs to be a positively geared property. It needs to be earning and generating an income that is then distributed to the beneficiaries. If not, it'll be negatively geared, and there's no gearing against your personal income, so this can actually take away from your borrowing capacity, and I'll explain that in a moment. But if the property is earning an income and that income is distributed to the beneficiaries, you will then have a tax return that shows you have an increased income. Now, if you have an increased income and you can prove the ongoing increased income to a lender, and that comes back to record keeping, any increased income may increase your borrowing capacity. But if the property is losing money, again, you have to think very carefully as to whether you would put it under a trust situation. Because any gearing benefit that the bank may allow you when borrowing will not be able to be realised because you can't claim any gearing effect against your salary because the property is under the trust. And some lenders do allow for gearing effect for properties purchased in personal names. Some important considerations to look at before buying under any entity: personal names, holding companies, trading companies, trusts, family trusts, whatever. You need to look at your long-term plans. You need to look at your immediate plans. You need to look at your current assets and liabilities, whether you're employed or self-employed, income, whether the property is negative or positively geared. And you need to look at whether you might want to asset protect your owner-occupied home if you're a company director. Really, unless you're looking at some form of asset protection, I can see no great reason in which to buy an owner-occupied property in anything other than your personal names. Now, to summarise this a little bit, the entities, we've got personal names, we have company names, be that a trading company or a holding company, and we have a company as trustee for the family trust or the unit trust. Now we're going to go into something completely different. We're going to go on to pre-approvals and some of the pros and cons of pre-approvals. After you've done your lender research and you're confident in the level you can borrow at, you may decide to go for a pre-approval before you head out on the purchasing trail. A pre-approval is only good if it is done properly. In my opinion, the worst kind of pre-approval is the online pre-approval. Don't take this the wrong way, but if you're sitting there in front of the computer and you're trying to get a pre-approval, you just might misunderstand a question. You might inadvertently give some misinformation. And then the pre-approval really isn't worth the paper it's written on. Similarly, if you might go into a lender or a broker and they give you a verbal approval or a basic approval, you know, where they sit there and they punch in the numbers on the computer and they say, oh yeah, based on what you tell me you earn, we can lend you this much. Same thing. Even if it's written on paper, it's not worth the paper it's written on. A pre-approval can only help if it is done properly. Now, to be done properly, a pre-approval should include every piece of information that you would have for a full approval, minus only the purchase contract. And even then, there is no guarantee of finance, because even though they've checked your records, your income, your finances, your assets, your liabilities, everything else, they still need to value the property after it has been purchased. And it may also hinge on the lender's mortgage insurance being approved. So be very aware of signing an unconditional contract unless you have clear access to the funds or cash. A pre-approval can give you some security and some help, but don't ever take it as an ironclad guarantee of finance. Lastly today, hopefully not leastly though, we want to look at the first home buyers grant and first home buyers. Why? Why in something that's aimed predominantly at investors are we going to include first home buyers? Well, investors need to start somewhere, and that might be buying their first house. Also, as an investor, you may one day wish to sell a property to a first home buyer. So you need to understand the process that they may have to go through in which to purchase your home. Pre-global financial crisis, or GFC, it was relatively easy for first home buyers to borrow 95% of the value of the property, 97% of the value of the property, even 100% of the value of the property. In some cases, a few lenders were lending up to 105% of the value of the property. Can you imagine that? That was just madness. There was no evidence of savings often needed. They could have short-term employment. Basically, if they had an income and a pulse, there was probably a way to get them a loan. Since the global financial crisis, however, lending in all areas has become a lot more restrictive. In some ways, we've stepped back 20 years in mortgages. Some lenders will only lend to 90% for new clients. There is still some that will lend to 95 and maybe even 97% of the value of the property if the clients have accounts or credit facilities with them, but very few. They will require a savings history now, what they call genuine savings, and they will more often than not require these savings to be held in their account for a 3 to 6 month period. So they can clearly see that either the funds were held over a period of time or accumulated over a period of time. They will also look at a first home buyer's job stability. They will have a very close look at the first home buyer's credit score. Generally, they want no adverse conditions on the client's credit report. What we've talked about before is their CRAA. And the client will need to prove they have the funds to complete the purchase. When we talk about genuine savings, the genuine savings may need to only be around 5% of the value of the property. But there will be other sources of funds the client needs to complete the purchase. Now, these might be way of a gift. They might be the first home buyer grant. They may be shares. They may be an inheritance. They need to be documented. You need to be able to show the bank or the lender that you have access to the funds that will complete the purchase after what they are going to lend you. It may be an asset sale, but The sale must be realised. You can't say, I'm going to sell my car to get this $10,000 I need to settle this purchase. You need to have sold the car and have deposited the money in the bank and show the lender evidence that the funds are available. It's no good just saying you'll sell it. Also, as we spoke about a little bit earlier, there's the family pledge. Lenders will require you to seek independent legal advice in this situation, but it may avoid the need for lender's mortgage insurance because it lowers the overall LVR below 80%. Remember though that if that loan defaults, the lenders will pursue the additional property that is held as security. So be very careful before entering into this type of loan. It wouldn't be the first time I've seen a parent's property repossessed because a son or daughter, all well-meaning, has had their property foreclosed upon. Now, a quick summary. In Disc 1, we covered getting started, record keeping, debt consolidation, common terms. In Disc 2, today, we've looked at borrowing entities, pre-approvals and the first home buyers grant. Hopefully you found it informative, and it shows you that you really need to do the research before just jumping in and making a purchase. Not only do you need to research the property, but you need to research the entity you might want to borrow under, the lender you might want to borrow with, and the product that you might want to borrow with. Each time we do one of these discs, I would encourage you to review the past discs, because it will really start to come together. In Disc 3, we're going to have a close look at the application preparation, the lodgement and tracking that application, the approval process, right through to the settlement process. Plus, we're going to look at some contract dangers. What we're trying to do in the next disc is give you a little bit of a look behind the scenes to help you further understand the process of applying for, getting a loan and settling that loan. So until Disc 3, keep well, and I'll see you then.